Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today we're taking a look at the prospects for markets and the investment company industry in 2016. Looking back at 2015, it's been a record-breaking year for the investment company industry, with industry assets peaking in May before settling at just below 134 billion at the end of November, well up on last year. The average investment company discount reached another historic record low this year at 2.4% in October, before widening out slightly to 3.2% by the end of November. It's been a more muted year for performance after the double-digit returns of recent years, with the average investment company up 3%. The top-performing investment company sectors were dominated by smaller companies, which took 3 out of the top 5 performing sectors. Enough of the past. Let's move on to the future. I'll introduce my managers, and we're very pleased to be joined by managers of 2 very well-known investment companies, and they are dividend heroes, companies which have increased their dividend every year consecutively. So we have Job Curtis,
Thank you.
Manager of City of London in the UK equity income sector, which has a 49-year record of dividend increases, and Paul Niven, Manager of Foreign and Colonial Investment Trusts in the global sector, the oldest investment company, which has a 44-year record of dividend rises. Right, on to the questions. Job, what are the key causes for optimism next year?
Well, I think the outlook for developed economic growth is quite good, really. I'm talking here about the UK, the market I mainly deal in, also the US and Europe. And I think one key factor is the decline in the oil price, which is putting money into the pockets of consumers. Of course, companies involved in the oil sector and those that supply them will suffer a bit, but overall it is a benefit. And in addition, I think within Europe you have quantitative easing, which has been going for a year, and finally the European economy is moving ahead. So I think the outlook for developed economies is quite positive. It's probably a bit more mixed in emerging markets.
Paul, what's making you optimistic for next year?
Well, I think there's a number of reasons for optimism in 2016. As Job said, the outlook for growth is positive. Actually, we expect the growth will pick up in 2016 globally to maybe 3%, as against 2.5% in 2015. Valuations in equity markets are reasonable, certainly not as cheap as they were several years ago, but they're still fair. And certainly we tend not to see bull markets in equities derailed before we reach extreme levels of overvaluation, or indeed we face a recession predominantly in the US, and we think neither of those factors are likely in the next 12 months. And finally, on the point on the ECB, we have abundant liquidity globally. The ECB is still easing policy. Bank of Japan is very supportive. So despite the fact that interest rates are heading up in the US and indeed likely the UK, we still are in a positive environment in terms of global liquidity.
Going on to your key causes of concern for 2016. Paul, what's concerning you?
Well, I think this point on interest rate policy is important. The Fed is hiking rates very soon, likely, and there's likely to be a number of rate hikes in 2016. Now, this is the first time that the US Federal Reserve will have raised interest rates for 9.5 years. We've been in a period of remarkably low interest rates, and we should expect volatility from markets as a response to that move. In addition, we are seeing peak margins likely in the US equity market, and something of a shift perhaps in pricing power from capital to labour within that market as the employment situation there continues to tighten. So the outlook is perhaps less positive than it has been in recent years for corporate earnings. And as I said, we're in an environment where the key central bank, the US Federal Reserve, is raising interest rates. In addition to that, clearly emerging market risks, in part related to China, but we do have issues in Latin America as well. And commodities clearly very volatile and very depressed this year, and a key risk for 2016 as well.
Okay, and Job, what are your concerns for next year?
Well, obviously, interest rates going up can have knock-on effects across markets. So I would mainly see that as a normalisation of economic conditions. Interest rates have been at very low levels since the financial crisis, and I think to move upwards might be considered a step in the right direction. I think there are elements of the stock market which are quite overvalued. There's a lot of enthusiasm amongst some of the technology type companies which would appear to be, by my considerations, overvalued. So I think there are elements of overvaluation. On the other hand, the outlook for the oil and commodity space looks very difficult, but on a longer term basis, value may be beginning to emerge in those areas. So as ever, stock selection is going to be very important, and it's not easy.
No, if it was easy, we'd all be very wealthy. Yeah. So, Paul, looking on to the regions next year, which regions do you think will be winners and losers?
Well, we've favoured Europe and Japan over the last 12 months, and we think that those areas can continue to perform in 2016, certainly relative to the US. There's several reasons for that. Firstly, the valuation case in those areas we believe remains reasonably strong. And we also think there's scope for catch-up in terms of corporate margins and overall profitability within Europe and Japan. Japan, we're obviously seeing reforms coming through, and both central banks from those areas are very, very supportive in terms of monetary policy. That's in contrast perhaps to the US, where valuations not stretched, but certainly less attractive in our view, margins somewhat elevated, and perhaps a bit of pressure coming in, as I said, from the labour market with maybe some rising wage costs there. In addition to that, the US Federal Reserve beginning to normalise policy in contrast to perhaps the actions of other central banks. Emerging markets, clearly a broad range of opportunities, very diverse set of economies. It's been very challenging for them for a number of years, and we think selectivity is required. Clearly, they've been significant underperformers. Value is beginning to emerge, but fundamentals unfortunately continue to deteriorate across emerging markets in general terms.
Job, would you like to comment on the regions?
I don't have a strong view. I'd just make the point the UK market, where City London is predominantly invested, is a fairly international market. Some 75% of profits come from overseas, and certainly if you look at some sectors like pharmaceuticals or oils, these are global sectors, so there is a degree of correlation between the various major equity markets.
Okay, so looking at sectors then, which sectors are well positioned for next year in the UK, Job?
Well, we had a very strong year last year from the house building sector, and it may be hard to think we're going to get as good a year coming ahead, but nevertheless I do think UK house builders are well placed. I think that our country's short of homes and more homes need to be built. There's a lot of demand from generation rent to buy their own homes. I think interest rates, even for a small increase, will remain relatively low. Houses therefore are affordable from an interest point of view. And the house builders I've invested in certainly have got long land banks and are well positioned to benefit. Another area which related is a brick company called Ibstock, which has returned to the market. And I think that as a brick builder, where there are 3 main brick builders left in the UK, that could be a well-placed company as well.
Okay, and how about sectors you're not so keen on for next year in the UK?
Well, it's difficult. I mean, the immediate outlook for the commodity sectors is quite difficult, and undoubtedly, we've seen some dividend cuts in the mining sector, and we're likely to see more. But you always have to be a bit careful, because you can have a strong top-down view, but the stock market acts as a discounting mechanism, and so at some point the share prices react to what's availably known in terms of information, and way ahead of the event the stock market tends to discount what is likely to happen. So at some point it could build into an interesting buying opportunity. So I wouldn't want to sort of be too rude about that area right now. I think that it could end up that during the course of 2016 a great buying opportunity might emerge in that area.
Okay, moving on to next year. Now, what's important, do you think, for your investment company, Paul?
Well, ultimately we have to deliver value for shareholders, and for that means growth in capital and income on a longer term basis for our shareholders. So clearly we'll look to build on recent performance, which in recent years has been strong. We will make the strategic decisions. We're fortunate enough to have a closed-ended company structure, which means that we can take a long-term view, invest in illiquidity, and for Colonial, We do have investments in private equity which are performing very well, maturing, and we're looking to re-engage into that area. So that strategic decision is clearly very important.
Interesting diversifying of the portfolio there.
No, absolutely, and these are historic commitments which were made some time ago, really coming to fruition now, providing very good returns against public market equivalents. So that's been a good source of value added. But shorter term, clearly markets have picked up in volatility terms, and I would expect more of the same in 2016. So we need to navigate the volatility, look for opportunities, whether it's on a sectoral basis or on a country basis, or indeed at the broader market level, to take advantage of mispricing in assets and clearly allocate towards our preferred areas, which, as I said, remain Europe and Japan for the time being. But just picking up on Job's point, I think emerging markets are very interesting. There is an analogy here with the commodity space, whereby at the present time the outlook looks relatively bleak, but one has to question when you're being paid to take the risk in that area and when valuation is sufficiently discounted or valuation levels are sufficiently discounted to allocate capital. I don't think it's yet, but there may be a situation where we actually make a positive move towards emerging markets sometime in 2016.
It's very interesting because in our fund manager poll, the managers on a 5-year basis were optimistic about emerging markets. They obviously think at some stage it's going to get better.
Well, I think managers are looking towards the longer term drivers of emerging market performance, which they would tie into demographic change and superior growth outturn to developed markets. And those drivers may well still be in place, albeit to a lesser extent than was the case some years ago. But I don't think many managers actually have that position on today. So I think it's right that people are looking for the positives in longer term emerging market story, but the question is one of timing, and timing is going to be very important in emerging markets, clearly.
Definitely. Now, Joe, what's important for your investment company next year?
Well, our investment trust has grown its dividend for 49 years in a row, and so if we achieve it next year, it'll be our 50th year, which obviously is very important to us. But we've only achieved this through investing in good companies that earn proper profits, earn cash profits, and also companies that are growing. It's not enough to invest in yield. It's a combination of yield and growth that gives you the overall performance. And we've also benefited from the investment trust closed-ended structure. We couldn't have done it without having a revenue reserve. So in the good years, we put small amounts into our revenue reserve, and that we can use to help our dividend in the difficult years for dividend cuts. So we've undoubtedly benefited from the closed-ended structure in order to achieve that 50-year record.
Well, I'm very pleased the closed-ended structure has helped you, but half a century of consecutive dividend rises is a great achievement. Very well done.
Thank you.
It's clearly interesting to hear the managers' views, but I'd like to emphasise that we don't have a crystal ball, so we don't know what's going to happen. Investment is clearly for the long term, and you need a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a happy and prosperous new year. Thanks so much for watching.